Good afternoon, Brenda. Kevin Gormley here with Brenda Hill. And Brenda, welcome to the Leading Edge team. It's now been a while, but I've been in the tax cave for the first part of the year, so I've not had the chance to have you on videos before. But Brenda, if you want to go ahead and introduce yourself, and then I'll throw in a few more things about you.
Yeah. My name's Brenda, as you heard. I recently started, I guess not so recently. I started here at Leading Edge in January. I have graduated from Liberty University with the financial planning program in 2022. And I was born and raised in Brazil. And so all of the concepts of retirement accounts, 401ks that are basic for everyone, I had to learn it because I didn't grow up with those. But no, I love financial planning. I'm very interested in, equity compensation. I think that's very interesting. It's something we don't touch on a lot for pilots. But I am here to just learn from Kevin and maybe throw in a little nuggets that can help you understand a little bit more about equity compensation and whatever else we can do to help.
Great. No, that's great. And also, Brenda has passed the CFP exam, just
Yes.
waiting on her time, basically. You have to have a certain amount of time, and then she'll be a CFP as well. So, good deal. Or a CFP professional. That's what we're supposed to
Yeah.
say. So Brenda, let's jump right into the chart that you put together here, and we're going to talk about the different types of compensation that people get. Equity compensation, equity, another way to say stock. So there's lots of differences and similarities between some of these different equity compensation amounts, and we are going to make this chart available if anybody wants it. But anyway, let's start with incentive stock options. Let's start with them. So an incentive stock option, the word option is in there, Brenda. Can you tell us a little bit about how you think about what an incentive stock option is?
Yeah. A good way to think about it is they are giving you the option, but not the obligation to buy a stock at a certain price. And let's say they give you the option to buy a stock at $10 per share.
Hmm.
Well, if that share is now at $100, you're getting yourself a really good deal by being able to buy that at a $10. However, if that stock falls to $5 a share, now that option is worthless. It's better if you just buy the stock at $5 than to use that option. So that's one way to think about it. Again, you have the option to buy it, not the obligation. So that's what the ISOs and NSOs are. The main difference between those two are how they relate to tax treatments.
Right.
So, yeah.
Right.
Anything else you want to add?
Yeah, let me pile on there. So, when people tell you they got stock options, a lot of times they tell you that they have it as if they've received something. And it does actually act that way if stock prices of your company go up over a long period of time. So, if you work for a company, you get an incentive stock option. Many times it's going to be at either the current price or maybe even the current price minus a little bit, depending on where you are in the pecking order within the company. But let's say, as you said, you get the option to buy a stock at $10 a share. It's at $10 a share. Now, if my stock never goes up and it just stays at $10 a share, it's really a worthless piece of compensation if it never goes above 10. Now, that's not going to happen in the real world, but that's the way to think about it. You have the option to buy. So if the stock goes to 100, and they call this the cashless exercise, we'll get more into this later. But if the stock's at 100 and I have the option to buy it at 10, there's $90 of goodness there between the price I can buy it and the option to sell. And a cashless exercise means I do them both at the same time. I think that's the easiest way to think about the option is it's really great to have the option to buy something at any time in the next 10 years because when the price goes up, you can go ahead and execute. So anything else that I've said, anything else about incentive stock options as far as what they are and how they work?
Yeah, I just wanted to add one thing. They do have nicer tax treatment if you decide to hold on to them a little bit longer. That takes a little bit of active faith. So if you hold, let's say you want to exercise the option, which means you're buying
You're
it.
just going to buy it.
Yeah. Yes, exactly. Now, if you have faith that in the next 10 years, it's either that price that you think it is right now is going to be maintained or is going to get higher, and you think it's worth it, if you hold it 2 years since it was granted and at least 1 year after you do this exercise, then you have better
Yeah.
tax treatment,
And,
like
and point to
Kevin
that
wants to.
using your mouse. Point to that
Yeah,
on the
right
chart
here.
there. Yeah, if held for 2 years from grant date and 1 year from exercise, you can get long-term tax treatment. Now, I'll just pile on here and say it's not just faith. It's actually you need the money
Yeah,
because
yeah.
if you're buying it at $10 a share and it's let's say it's 5,000 options to buy, it's 5,000 times $10. You have to have the 50,000 to buy it. So it is definitely faith. You have to believe that the company is going to do okay. And you really want that long-term tax treatment, you could pony up the money and buy it. For the most part, most of our clients don't do that. So usually it's just the difference between the two prices. So let's run through these words on the screen here. We have grant, we have vesting, we have exercise. What do all those mean?
Good question, Kevin. So, grant means it becomes available to you as an employee. So, that's the
Right.
grant. And depending on what they are, you need to either hit a performance goal or it's time based on however long you've been in the company. But grant is when you receive it.
Right.
Then a vesting schedule. Vesting means you receive it, but it's not fully yours yet, which is a little bit confusing. You have it, but you got to meet certain conditions before it's fully yours. And
Right.
then exercise is whenever you take action on that, when you buy the option, when you basically take an action, which is not really applicable for RSUs,
Yeah.
but
Yeah.
that's what that means.
Yeah.
And then
So,
the sale is when you sell. So exercising is like you're buying it, like the example of the ISOs, like you'd have to pony up the money, like you're talking about, Kevin. That's exercising. And then there's the sale, which can either happen at the same time, which would be a cashless exercise, or you can choose to do it later, depending
right.
on your preference and specific situation.
Right. So we just had Easter. I'll use Easter as an example. You get a big chocolate bunny. Your parent says, "Hey, I bought this for you," and you go to grab it, and they say, "No, it's not yours really yet. I just wanted to show it to you." So they show it to you. That's the grant. They show you that you have this option and that it's available to you. Now that's really important for something called 83B in a second, but it's for you. It's been granted for you. The vesting is the time period you have to wait until you could actually exercise the option. So in this case, your parents give you the chocolate bunny rabbit, but say you can't open the box. So you have to wait until it's vested before you can open the box. And then the exercise actually would be being able to go ahead and execute eating the chocolate bunny or going ahead and buying the stock. And again, most of the time when people exercise, they exercise and sell at the same time. So now let's come back to the grant when it comes to ISOs or non-qualified stock options. You have a thing called 83B, and if you're not familiar with it, Brenda, that's okay. I learned about it
Is it
well
when you pay
after.
income tax ahead of time, basically, when you receive it?
Yeah, exactly. Well, you do know. All right, well, good. So we've had people before that are in startup companies, and they receive an ISO when the company starts, and it's 30 cents a share right now. And so if you go ahead and have 1,000 shares at 30 cents, not a lot of money to pay tax on. You do an 83B election and you tell the IRS, I want to pay taxes now. And so that's the reason why the grant date is important. You could do an 83B. We're not going to tell you if you should do it or not. Definitely talk to your tax accountant and or your financial people. But that's why the grant is important. And then the other reason why the grant is important, if held from 2 years from the grant date and 1 year from exercise, that's another reason why the grant is important. So let's go to the pros and cons of just the incentive stock options and the non-qualified stock options.
Okay. So the pros of the stock options, the biggest pro is that you kind of have the biggest upside if it really works out for you. You can buy something really cheap and sell it really high. And if you do a cashless, you kind of know that guaranteed.
Right.
If you choose to do that, you know exactly where you're selling it for as you're buying it. So that's a big pro. Another big pro of the ISOs is that you don't owe taxes at exercise. You owe
If
taxes
you
when you
buy it,
sell.
if you
If
buy it and don't
yes,
sell it. Yep.
if you buy and don't sell, you don't exactly. So you will pay taxes when you sell, but if you choose to do that whole situation of holding it for a little bit to get the long-term capital gains, you don't owe taxes until you sell.
So you talked about the ISOs. The only difference with the non-qualified is you can't buy it and hold it for a year. But is
Yeah.
there, you mentioned, I think, the biggest pro there, Brenda, and the biggest pro is that you have the opportunity for leverage. So, when you have a incentive stock option, you can make huge money because you have the opportunity to buy at a price. And if the stocks, stocks can run, we've seen stocks run 1,000% up, and so you have a great amount of ability to make a ton of money. So that's the pro. Is there any other pros to stock options other than telling your friends, "Hey, I got a bunch of stock options when I joined the company"? Any other pros?
I mean, there are pros for the company itself because it's encouraging people to stay there for a long time
Sure,
and to
sure,
kind of
that's
bet
good.
on the company. So there's that side of it. But I think for whoever is receiving the stock options, you're right. I think that's the biggest pro, really, versus like all the other possibilities.
Okay, so what's
Um,
what's the negative? What are the cons of stock options?
Okay. Depending on several circumstances, stock options can trigger something called AMT, which I'm not going to go much into detail, but it
Right.
can cause a tax event. But that really only happens when you are really well off with the stock option. So it's not really a con in my opinion.
Right.
If you have too big of a difference between your option price and the share price that it triggers this taxable event, I feel like you're still fine because the difference is
Okay.
that big that's triggering that. So you're still, I wouldn't
Yeah.
say that that's a
You're going
very
to make $3
big
million
con. Yeah,
dollars, and you have to deal with AMT. All right. So who cares?
yeah,
It's important at that point. We get that. But
yeah. And
what's the other
the
downsides?
biggest con is it can become totally worthless. If you have the option to buy something at $10 a share and it just keeps staying at $10, a little bit lower, it's worthless. So there's a chance that that compensation is not really a compensation, it's for nothing. So that's the biggest con of the stock options.
Yeah,
So
absolutely. So I'd like to go ahead and brag about myself here. When I was at pharmaceuticals, I had SmithKline Beecham and then GlaxoSmithKline options to buy the stock. And so the price was about $43 a share rather when I got the options. And then over the next 10 years, the price never went above like 45. And by the end of the 10 years, the price was below 40. So yeah, I got nothing. So that's the issue with stock options is that you can be the hero or you can also get zero. And I think that's the pros and the cons. So you have down there employers who expect long-term growth of a stock. Again, everybody thinks their company is going to be worth more in the future, but for smaller companies or nimble companies or growth companies, these options can really be tremendous. So,
mhm.
I think that's the benefit for our clients that get stock options. And then the final question I'll ask you, and I know there's no answer for this, but I'll still ask you to see what you say, Brenda, is when do you sell? Like the price went up. Price went up 10%, price went up 20%, price went up 100%. When do you actually say, I'm going to execute the option and then sell? When do you do it?
It depends. I think that's the answer. It depends.
Yep.
Do you think that it's going to go higher? I mean, if it's a company that you're working for, you might know more than the average person and really believe that, the growth of the company. It depends. So I don't know that you're right, there's no answer for it
Yeah.
really.
Yeah. Hope
But
is not a strategy.
yeah,
So when you need the money, that's
yeah,
sometimes a good time to go ahead and do it. If you're putting a new wing on your house or want to go on vacation, I think those are possibly good reasons. There is Black-Scholes option theory but again, nobody knows the future, and that's really the problem. Is I've seen so many people over the years make themselves emotionally less wealthy by really trying to figure out the best time to do stock options, and there's nobody knows. Nobody knows. So you could have $2 million of stock option value right now, and you could execute, and then the stock doubles again, and you say, "Man, I could have had 4 million." So I think doing some executing a little bit at a time might be a good thing. We're going to get into other types of stock compensation. When you have multiple types, you might want to let the options run for a while and just see what happens because you have other compensation. But yeah, there is no perfect time. So anything else about options before we move over to I think employee stock purchase might be the next or RSUs.
Yeah. No, I think we covered most of it. No, I think we're good to go to the next one.
Okay, so RSUs is the next one on there. So first, if you can describe what happens with an RSU, what do I get when the company says, "Hey, you got an RSU"?
So an RSU is actual compensation.
Okay,
You're actually receiving something. So back to the Easter example. So with the ISOs, the Easter eggs, they can kind of disappear. I'm trying
right.
to make the analogy work.
Mom and dad
They
could
kind of
eat.
get
Mom and
lost.
dad could eat
Yeah,
the chocolate.
yeah. But with the RSUs, the eggs are there.
Yep.
The eggs will continue to exist. So you have, once you get the RSUs, you have the shares. It's compensation. Now, only way that the RSUs will become worthless is if your company goes completely bankrupt and the stock goes down to zero.
Yeah,
That is the example.
or you
Or
don't continue to work there
yes, that too.
if you
Before
quit.
it gets yeah, before it gets unrestricted. So you're right. So RSU says the name restricted stock units. So you're gonna get the chocolate, you're gonna get the Easter eggs, and you're gonna have to for a while go through a vesting period or whatever it takes to make them unrestricted. And now it's yours.
All
So
right.
now that
So
it's yours, you can lose the value of the stock going up and down, but you've received something. So it's always gonna be like a net plus. That
all
makes
right. So your
sense.
parents bring in some chocolate. They tell you it's for you, and you can look at it. So they put it on the other side of the room. You can look at it, but you can't even hold it. You can't take it with you because it's restricted. And then so during that period, but you've been granted it. So you have it. It's there. You can see it. It's on the statements. It's whatever website your company allows you to see the RSUs. But they're not
Mhm.
really yours, right? Until the vesting period is over, and then they become unrestricted. So what do most companies do when they become unrestricted? So let's say it's 2 years. They become unrestricted. Now the chocolate is actually handed to me, and what do they do at that point? What do most companies do when stocks become unrestricted? Because there's something that's pretty typical, and maybe you're not aware of what most companies do. I can
I
tell
might
you
not
some of them.
know. Yeah,
Yeah,
fill
yeah,
me in,
yeah.
Kevin.
That's
Yeah.
okay. Yeah. So typically what the companies will do is they'll take your piece of chocolate and they'll cut off 1/3 of it and send that to the IRS. Like that's something that Bill Murray said. I want my child to understand taxes. I tell him that he can only eat 2/3 of his ice cream. That's what Bill Murray has said. So yeah. So what most companies do with restricted stock is when it becomes unrestricted, they take 1/3 of the shares, they sell them, and they send that money to the IRS. So you are paying tax. It's a taxable event. As Brenda's already said, this is compensation. So when it's restricted, you don't have to pay any taxes. As soon as it's actually your money and you get presented the stock, then it becomes taxable. And most companies will take 1/3 of the shares, sell them, and send that to the IRS. So now,
Yeah, I
now what
didn't
do
know
I
that.
own?
Thank you.
What do
Yeah.
I own? Let's say I work for GlaxoSmithKline again, GSK. So I get my stock, it becomes unrestricted. They send 1/3 of the shares to the IRS for tax. I paid 33% tax. What do I now own with GSK? Is it still called a restricted stock or is it an unrestricted restricted stock? What is it?
You own the shares.
You own the
You own the
stock.
share. You own the stock.
Oh,
And that brings me back to the point, Kevin,
yeah,
that I know you want to touch on.
yeah,
If you had gotten a $50,000 bonus at the end of the year,
right.
would you use that $50,000 to buy that stock, your company stock?
Yeah, that's a good question.
Because that's kind of what you're doing. You got to see the opportunity cost here. If you're holding on to the stock that now you own, it's your stock. I mean, if you didn't already have it there and you just have $50,000 cash, would you rather put it somewhere else? So how much
Yeah.
you believe in the company, and people get emotionally attached to those stocks, but really, if you reverse engineer, is it really what you would do in that
Yeah.
situation?
Yeah, so I think that's a beautiful statement that would you buy the stock? There's some guilt that's involved sometimes, especially, we have people we work with that are C-suite people. When they do sell the stock, it actually gets publicized. So that's kind of interesting. But most of the people we work with, it's no big deal if they wanted to sell the stock. So that really is the question. When they take 1/3 and they send it in, would you buy that stock at that price? Or would you not? And then the second issue is if you got paid a bonus of $50,000, what would you do with it? Would you buy the stock or would you buy a boat? I mean,
Or
think about it.
diversifying to something else? Yeah.
Yeah, yeah. Or what we usually recommend, and this is absolutely a mental game here, is that when people get the stock, we say let's diversify and invest it in a basket of stocks because you already have so much risk with your company. You could be terminated, you could quit, whatever the case might be. The company could sink. The CEO could do something very, very bad. There's lots of things that could happen. So you already have a lot of risk with the company. So why don't you diversify into S&P 500, total market, total world index, or whatever? But really, you could just cash it out and keep the money, couldn't you?
Yeah. And the whole point is, it really is your decision, whether you want to keep it, you want to cash it, you want to diversify. I mean, I was just hearing the story the other day of, I forgot his name, but the guy who used to be one of the co founders of Apple, I believe, and he sold like 10% of his shares at Apple for $800, which now would be worth a crazy amount of money. I mean, is your company going to be the next Apple? Probably not. But you got to be comfortable with your decision in this situation. You choose.
Yeah. Yeah, yeah. My dad's the king of the one-liner, and I just saw him last week, and he said, seemed like a good idea at the time. And that was a famous quote from a movie. So again, we never know. Hindsight is always 2020. We never know what's going to happen with the price. Most companies go bankrupt. Not most companies don't become Apple, but Apple
Yeah.
did become Apple. But yeah, so let's get back at this. So Brenda, as far as the taxation of an unrestricted stock when it becomes unrestricted, what type of tax do people pay?
So when you receive the stock and it's unrestricted, like you're saying, Kevin, then the company will pay a little 1/3 to the IRS as ordinary income tax because, as Kevin said, that's compensation. Now, if you hold that stock for a while, then whatever growth you have with that stock or loss will be treated as any other stock in your portfolio. You can have short-term capital gains if you've held it for less than a year and sell it. You can have long-term capital gains if you have it for over a year, or you can take losses if you need to later down the road. So it kind of works just as anything else. Anything else to add, Kevin?
Yeah, I mean, I just think that if you think about this as just a bonus, it's easier to think about the tax. You got a bonus, you have to pay tax on an ordinary
Yeah.
income. The other part of the goodness of this for the company and many times for employees is that if the company does well as well, they'll get more of a higher bonus. So there's a little bit of helping to drive the company mission when you own these unrestricted shares because you want them to become unrestricted, and then the price will be higher. You'll get a higher bonus. You'll pay more tax. So let's say that you have $100,000 of shares. It becomes unrestricted, and boom, 33,000 is sent to the IRS. You own the other 67,000. And then the stock price goes up to $100,000 of value again. So you pay tax when it was at $100,000. They sent away 1/3 of your shares because of your income was 100,000. Now you own 100,000 again. So once again, the same thing happens. You have to have a capital gain between the 100,000 and the 67,000, and that's taxed at long-term capital gains if you hold it for a year and a day. Good deal. So what are the negatives about restricted stock or RSUs?
So one of the negative things back to the taxes is that you may receive the RSUs and you may pay ordinary income tax. And then the next year that drops. So you just pay tax on something that now it's worth less than when you received. So that's one of the negative things. If you get an RSU, decide to hold it for longer, and then the stock drops, you could take losses, and it could kind of make it a little bit better, but nobody likes to. So percent wise, you're even paying more than you would, if you had just sold it right then and there. So that's one negative of the RSUs. And the other negative is what you said is that once it vests, taxes are due. You can't
Right.
defer that for later. So if you're in a high tax bracket today, there's not much that you can do to avoid that outcome of you're going to have to pay whatever it is that your ordinary income tax bracket is on those shares because that's compensation. So that's the other
Right.
negative too. Yeah.
Right. Right. So you can't control the timing. The timing is the timing. When the shares vest, you got to pay tax, and it's ordinary income. So that's the issue with that. Okay, now we're going to get to the difference between all the different ones. Let's talk briefly about the employee stock purchase and how those shares work. Let's not go too deep into the tax. We can come back to that another time. But in essence, what are the employee stock purchase plan, Brenda? What do you get, and how do they work?
An employee stock purchase plan is, it sounds similar to the options, but a little bit different. You can get the stock at a discount.
Right.
That's what it is. It's like an employee discount. If you work at Dick's Sporting Goods, you can buy tennis shoes for 20% discount. That's kind of how it is. So you work for the company and they give you the option to buy that share at a discount. A lot of the times people use that as a payroll deduction to just have that ongoing. But honestly, if you already have a lot of other equity compensation, that's not very, very necessary. But it is nice because you're paying a discount, so you're automatically getting a benefit right there. So a lot of people do it for those reasons. But what else do you have to add, Kevin?
Yeah, so I mean, let's say the stock price is $100 a share, and I get a 15% discount. So I'm buying it at $85 a share. That's great. That's fantastic. You do have a period where you have to wait before you can sell it, or most of the companies you have a vesting period. You can't turn around the next day and sell it, like that would be $15 of gain the day after I execute the option, or excuse me, the stock purchase plan. So you usually have to wait a period of time. And then when you do sell it, there's extremely complex tax rules. So we won't get into them here. But in essence, okay, so 2 years after I do an employee stock purchase plan, I buy them for $100. 2 years later, the stock price is 150. We call that a really great investment, right? That's really fantastic. 2 years later, the price could also be 50. And so that's, there is a benefit to it. It is a freebie. And what I've seen over the years, Brenda, you've probably not lived through this, but whenever the stock price has gone up a lot in the past, everybody wants to do this. When the stock price stays down for years, we work with a lot of airline pilots. This was the rage a few years ago. Now, very few pilots talk about this as part of their plan. It's not a bad idea, not at all. If you want to use it, you get a discount. It is good. We think it's probably on the checklist, probably like 4 or 5 down after funding your 401k, backdoor Roths, college, emergency savings, everything else. But it is good. Now you own the one stock, right? That's what you own. You own the stock, and it looks just like any other stock you would buy at E-Trade or Charles Schwab. So anything else about the employee stock purchase plan? Again, it seems very simple, not from a tax perspective, but it seems very simple that you buy the stock at a discount and you own it.
I think one good reason some people might like the employee stock purchase plan is just for the practicality of it, really. You can just, people don't feel it. It's getting deducted from your paycheck. So a lot of people like it from that perspective, but I'm with you. I mean, there are other ways, other vehicles to where you can also, not freebies, but if you're well diversified, I feel like that's as close to a freebie as you can get. I
Yeah,
don't know if
yeah,
I was supposed to say
yeah.
this, but
No, no. I mean, look, when people have asked our opinion, we've almost never said no. We've
yeah,
just said, diversification is important. Getting the benefit is good. And there's chances that the stock price might not keep going up. I mean,
yeah,
and when the price does go down, that might be a good time to get the 15% discount off of an already discounted price. So let's talk a little bit about how we view the different vehicles. I'll just start out by saying stock options, they could be big dollars, they could be no dollars. Restricted stock units, restricted stock. Sometimes they're just called restricted stock, depending on there is a designation for both of those. They are almost always valuable. They're just usually you're not going to hit a 10 bagger on them. The stock usually is not going to go up 10 times in the time that it becomes unrestricted until time that it becomes restricted to unrestricted. And then employee stock purchase plan, you're basically buying the stock. But as you said, the doing it automatically really is a benefit to a lot of people. All right, so now we'll talk about a person that has all of these. Okay, how do we think about what to do when you have all of these right now, and they're all able to be exercised? They're all vested. How do you decide what to sell?
That's such a good question, Kevin. And I think the question can only be answered with more questions.
Yeah, yeah. Go ahead.
Um, so, first thing you got to ask yourself is, what do I believe this company will do? Do I have faith in this company? Do I not have faith? So that's one thing that you got to ask yourself. The other thing is, how well diversified am I in all of my other investments? How much of this is the piece of pie in my financial life? Is this 30% of my pie? Is this 5% of my pie? The
Right.
less percentage, the less I care, because then, it can have high rewards. But if this is too much of your retirement or of your financial security, then I would lean more towards, okay, what is the best way that we can start getting rid of them? Whether that's
Right.
slowly, whether that's, like an automatic, just, I think those are the first questions that would give us the baseline. Okay, then we get to decide what we're going to do. And back to the first question, if you believe that the company is not going to go up at all, like that alone is an indicator, well, then you shouldn't keep them, you know?
Right. Right.
So,
I think that's brilliant how you said it because this does create a new risk, and the risk is of having all of your money owned in your company stock. You work for the company, all your company, like 30% or 40% of your money is now in these investments. And yeah, maybe it was earned by you and it's your money. But when the stock does crash, which it does happen sometimes, they call it whistling past the graveyard. The people that their stock tripled and quadrupled and got a 10 bagger, they're whistling as they walk because they kept all these different vehicles. But all of the people that company failed or they ended up losing money or making no money on these things, they don't talk much about it. They're not going to tell other people, yeah, I blew it. I held on to these things for too long. So I will say this, the restricted stock units to me are the easiest ones that when they become unrestricted to sell those. That's the easiest one. Now, I'm not saying you should always do that. I'm just saying that's a pretty easy thing. The employee stock purchase plan, they have rules. You have to hold them for at least 2 years. So I think holding on to them at least until the taxation becomes more favorable can be a good idea. If you have all of these, I'm saying, if you have all of these. And then the incentive stock options, that's the hardest because we never know what the price is going to do in the future, even if you have faith in it. I had faith in GlaxoSmithKline all the years I worked with them. We had a lot of great products. Price never went up. Didn't matter that I had faith. The markets don't care what we believe. But those are the ones that if the company really takes off, those are the ones that can make you millionaires,
yeah.
multimillionaires. So
And
those many
you made
times,
me think, Kevin.
yeah, go
You
ahead.
made me think about it. I'm sorry that I interrupted.
No, go ahead.
Um, to me, it's easy. So in my checking account, I have vaults, and to me, it's easy to separate certain pieces of my money for certain purposes. So I'm thinking to myself, well, one of the things that I wouldn't be opposed to doing is, okay, let's say I decide, all right, I'm going to sell my RSUs because if I had gotten this as a cash bonus, I wouldn't go out of my way to buy it. So let
Right,
me sell it. But then I would be like, let me hold on to this money for a little bit, maybe get a little bit diversified or just, something low risk. Let me keep this. And then if there's a good opportunity later down the road that I want to exercise those options, I have the funds for that if I want to.
It's
To
true.
me, that makes it all stay in the one category in one lane. But I wouldn't feel like I would be, because part of the sacrifice is like, gosh, I'm going to be putting so much money into those options. If you want to do the favorable tax treatment, anyways. If not, it doesn't
Right.
really matter. Um,
Right. I think what you just said is absolutely the case, and so I'll just I'll kind of sum up our discussion today. Understand what you have and how they work. That's the first mission, I think, for all people that get equity compensation. Stock options give you the opportunity to buy the stock, which is really a tremendous opportunity if the stock goes up in value. You can make a lot of money. There are some tax issues with that. Consult your tax person. But if you can buy something at $10 and sell it for 100, that's really good. Stock doesn't go up or just stays pretty level, they're not that valuable over the long run. So there's great risk. With great risk comes great reward, and that's why those are great. Restricted stock are compensation. Think of them more as a bonus. When they become unrestricted, you pay tax on that bonus. You then have tax word constructive receipt. You've actually received them. You can do something with them. You pay tax. I liked how you said you could sell them, and if you have a combination of stock options and them, you could bank the money, maybe earn some interest on it, and use that in other ways to maybe even buy the stock with the stock options. That's an interesting idea. And then finally, employee stock purchase plan. It's just like buying your own company at E-Trade or Charles Schwab, except you get a 15 or 10% discount, sometimes maybe even 20, but you must follow the rules of the road when you do that. And we think all of these are fantastic. We're really excited that people are offered these. But then when you have too much of them, then again you come into a new risk profile with having too much eggs in one basket. So, any final comments, Brenda, before we end the video?
I think you summed it up great, Kevin. You really did. And just to add to what you said, having too many eggs in a basket. I feel like we're having a lot of Easter references today.
Yeah,
One big egg is that you're working for that company. So I mean, that alone is a risk.
right.
Plus, a lot of your finances being tied to that. So how much of that is the percentage of your total portfolio? I would say
Right.
it's a big question to ask yourself. I think you've done a great job explaining. Thank you for even explaining things to me and helping me understand more details about them. They're not easy to understand sometimes, but you're right. I'm so happy that companies are doing that. Gives employees a sense of ownership, and yeah,
Yeah.
I think you've done great explaining everything, Kevin.
All right. Well, we'll end it with a Tennessee expression, and it's that pigs get fat and hogs get slaughtered. So these absolutely can be something that can help you to get wealthy. But if you're too much of a pig about it, and you try to get too greedy or too fancy, sometimes you could lose it all. So anyway, Brenda, thanks so much for the time, and you be well. And if you all have any questions for us, please contact us. Thank you.
Leading Edge Financial Planning LLC is a registered investment advisor. Advisory services are only offered to clients or prospective clients where Leading Edge Financial Planning and its representatives are properly licensed or exempt from licensure. For additional information, please visit our website at www.leadingedgeplanning.com. The information provided is for educational and informational purposes only and does not constitute investment advice, and it should not be relied on as such. It should not be considered a solicitation to buy or an offer to sell a security. It does not take into account any investor's particular investment objectives, strategies, tax status, or investment horizon. You should consult your attorney or tax advisor. The views expressed in this commentary are subject to change based on market and other conditions. These documents may contain certain statements that may be deemed forward-looking statements. Please note that any such statements are not guarantees of any future performance, and actual results or developments may differ materially from those projected. Any projections, market outlooks, or estimates are based upon certain assumptions and should not be construed as indicative of actual events that will occur. All information has been obtained from sources believed to be reliable, but its accuracy is not guaranteed. There is no representation or warranty as to the current accuracy, reliability, or completeness of, nor liability for decisions based on such information, and it should not be relied on as such.